Welcome to the deep dive. Today, we're doing something a little different. We're taking the Bausch Health Q3 2025 earnings call, but we're skipping all the prepared remarks.
All the scripted stuff, yeah.
Exactly. We're jumping straight into the most important part, the Q&A. The back and forth between the analysts and the leadership, CEO Thomas Io and CFO JJ Schoen.
This is really where you find the interesting details. Because the analysts, they know exactly which questions to ask, where all the pressure points are.
So what were those pressure points this time around?
Well, it was really focused on three big things. First, what's the real story behind the growth of their biggest drug, Xiaxin? Second, the massive threat from the IRA price negotiations and how they plan to, deal with that.
And the third?
And finally, the deleveraging plan. How are they actually going to pay down all that debt?
So we're going to break down the answers they gave.
Okay, let's start right there with the heart of the business, Xiaxin. The revenue growth in Q3 looked, fantastic on paper, but the first question out of the gate from an analyst was a sharp one.
It was. Why was revenue growth so much higher than the actual growth in prescription volume? Where was that extra money coming from?
And that really hit the nail on the head. Because the company immediately had to clarify that a huge chunk of that performance came from what they called a one-time non-cash benefit.
So not from just hiking the price of the drug?
No, not at all. This wasn't a sustainable price increase. It was something else entirely.
So what was it? What is this non-cash benefit that suddenly appeared in Q3?
It all comes down to a really complex accounting topic called gross-to-net accruals. Essentially, companies have to estimate how much money they'll owe in the future for things like government rebates.
Like for Medicaid?
Exactly. They set that money aside. But Bausch Health just made a huge strategic move effective October 1st to completely exit both the 340B and the Medicaid channels.
Wait, hold on. They just walked away from channels where they're forced to give these massive legally required discounts?
Precisely. And the moment they did that, their future liability for those rebates just, poof, disappeared.
And when a liability disappears from the books?
That money flows right back to the income statement. That's the benefit. It's an accounting gain from a strategic decision, not a real repeatable bump in revenue.
That is such a critical distinction for anyone listening. So if you strip out that one-time gain, what do they say is the actual, normal pricing trend for Xiaxin?
They were very clear about this. They told analysts to model for typical year-over-year price growth in the mid-single digits. That's the real number.
Okay, that cleans things up. But even with that accounting noise, the underlying demand, the volume, that still matters a lot. What did they say about new patient growth?
The fundamentals there actually look really strong. New patient starts were up 14% in Q3.
14%, that's a huge number.
It is. It came out to 71,000 new patients in just that quarter. And they said it's being driven by spending. They doubled their investment in direct-to-consumer advertising and are using an AI engine to target customers better.
So the underlying demand is solid. Which brings us to the elephant in the room, the Inflation Reduction Act. That's the big threat hanging over all this volume.
The biggest threat, yeah. Analysts needed to know just how bad the damage is going to be.
So what did we learn?
Well, first, the negotiations with CMS, the government agency, are over. They're done. The final price is expected to be published on November 30th.
And how much of Xiaxin's business is actually exposed to this?
They said it's approximately 30% of Xiaxin's total volume. So a third of their biggest product is about to get a mandatory price cut.
30%? That's significant. Analysts must have been projecting a major hit to their future profits.
They were. And this is where the company dropped a bombshell. This is the moment that I think changed the whole narrative of the call.
What did they say?
They projected that their average adjusted EBITDA for 2026 and 2027, so the 2 years after the price cuts hit, will not be materially different from their 2025 outlook.
Wait, what? How is that possible? You take a major price cut on 30% of your biggest product, and your overall profitability stays flat.
I know. It's a staggering claim. It implies they have an almost bulletproof mitigation plan.
So what is that plan? How can they just absorb a hit that big?
It means a few things. One, they must have extreme confidence in that underlying volume growth we just talked about, that it can offset some of the price drop. But more importantly,
It has to be more than that.
it has to be. It suggests they've got major mitigation plans across the entire company. Things like cost controls, growth in other products, just operational excellence everywhere to basically neutralize the hit from Xiaxin. They're betting the whole farm on it.
What about the next threat down the road, generics for Xiaxin?
Yep, they're already planning for that too. They said for 2028 and beyond, They're just assuming a typical erosion curve you'd see when multiple generics enter the market. So their entire strategy is about maximizing cash right now.
Right. Before the IRA in 2026 and before generics in 2028.
The clock is ticking.
Okay, let's pivot to the overall company financials then. They raised their full-year guidance, but the revenue part of that raise seemed kind of small, only by $25 million. Why so modest?
It goes right back to that first point we made. They were deliberately being conservative. By only raising the revenue guidance by a little bit to a range of 5 to 5.1 billion, they're sending a very clear signal.
Don't get used to that big Q3 number.
Exactly. They were telling analysts, do not model that one-time accounting gain as a recurring thing.
So if the revenue raise was small, where was the real confidence in the new guidance?
It was all in profitability and cash. The adjusted EBITDA midpoint went up by $50 million. That's a pretty healthy 7% increase versus last year. But here's the really critical number.
Go on.
The adjusted operating cash flow midpoint jumped by $150 million.
$150 million. That's a huge increase in expected cash. That signals something fundamental has changed in how they operate.
It does. Cash is what you use to pay down debt, so this is what really matters. The CFO didn't spell out every detail, but it points to much stronger operational discipline. Better inventory management, collecting payments faster, just running a tighter ship. That's the real positive story here.
Speaking of discipline, analysts also asked about their operating expenses, their SG&A. It looked really low in Q3.
Another really important modeling detail, the company basically warned everyone on the call, don't use that number.
So that was another one-time thing.
Yep. Another non-recurring accrual change. They explicitly told analysts to use the higher numbers from Q1 and Q2 as a better guide for the future. If you modeled based on Q3, you'd be way off.
Let's touch on one more operational point, something that's on everyone's mind these days. Tariffs and supply chains. Where do they actually make their stuff?
They gave some good clarity there. They said manufacturing is regional. For Xiaxin specifically, the country of origin is Italy.
And there are other U.S. drugs.
Mostly sourced from Canada.
So are they exposed to any of the trade tariffs we've been seeing?
And this was a big point of relief for investors. They said that under current trade agreements, both with the EU and the new U.S.-Mexico-Canada agreement, pharmaceuticals are explicitly excluded from tariffs.
So they're insulated.
For now, yeah.
Yeah.
They have no material tariff exposure, which is one less thing to worry about.
Okay, let's shift focus to the future then. Our R&D, the pipeline. What's the latest on Red Sea? That's their big shot on goal for preventing overt hepatic encephalopathy.
Red Sea is probably their biggest growth driver outside of Xiaxin. And we got a very clear timeline. They have 2 big global phase 3 studies. They're both fully enrolled, and they've decided to combine the readouts for both trials into one event.
Okay, and when do we see that data?
They're targeting the first quarter of 2026 for the initial data. This could be a huge moment for the company's value.
And remind us why the market opportunity is so big here. It's about prevention, not treatment, right?
Exactly, and that's the key. The current market is for people who already have the condition, OE. That's about 650,000 adults in the U.S.
But Red Sea is for people who don't have it yet.
Right. It targets the 1.9 million U.S. adults who have cirrhosis but have never had an OE event. If you can prevent it in a population that large, you're talking about a massive, durable new revenue stream.
Let's circle back to that commercial change we started with, exiting the 340B and Medicaid channels. Other than the accounting benefit, what was the actual business reason for doing that?
The official rationale was all about optimizing their sales channels and improving the patient experience.
How does leaving a channel like Medicaid improve the patient experience? That seems counterintuitive.
Well, it lets them replace the government bureaucracy with their own program. It's called a Patient Assistance Program, or PAP.
And what's different about their program?
For eligible patients, it brings their out-of-pocket cost to 0. But here's the really big operational change. It's the script duration.
Ah, right. Under Medicaid, it was a 30-day supply.
A mandatory 30-day limit. Under their new program, patients can get up to 90 days of treatment in a single prescription.
And for a long-term drug like Xiaxin, that's a huge deal for making sure people actually take their medicine.
It's a profound difference. Better adherence means better patient outcomes, fewer hospital visits, and for the company, it means stickier, more reliable revenue. They're trading exposure to government discounts for better patient compliance.
Which brings us to the final piece of the puzzle, the capital structure, the debt. What's the path forward to finally get that under control?
They laid out their priorities very clearly. Number 1, pay down debt. Number 2, reinvest in the business. And a very distant number 3 is returning capital to shareholders.
So debt is the absolute focus.
It is. And the primary source for that is still the free cash flow from the business, which they expect to stay pretty stable, thanks in part to that $150 million cash flow improvement we talked about.
But that's slow. That's an incremental way to pay down such a huge pile of debt. What's the big move, the solve, that analysts are looking for?
That's a multi-billion-dollar question. They ran through the options. Trying to buy back their own debt at a discount is less likely now that the price is recovered.
And raising new money from stock.
Very unlikely. The share price is too low. It would be way too dilutive for current shareholders. So that really only leaves one major option on the table.
The sale of an asset.
Yes. And the most logical, most probable candidate is their equity stake in Bausch plus Lum, the B&L stake.
Why is that one so important to the plan?
Because it's a purely financial asset for them. They can sell it, raise billions of dollars in cash to pay down debt, and it doesn't reduce their current operating EBITDA one bit. They're not selling off a factory or a drug pipeline.
They're just monetizing a stock position.
Exactly. It's the cleanest way to accelerate the deleveraging plan.
So if we pull all this together, what did this deep dive into the Q&A really tell us?
It shows a management team that's all about execution and mitigation. That big revenue number in Q3 wasn't what it looked like. It was an accounting move tied to a strategic shift to improve long-term patient adherence.
And they made a huge public bet that they can absorb the IRA hit and keep their profitability flat through 2027.
A massive bet. And their whole capital plan now hinges on selling that B&L equity stake to get the debt sorted out, all while they push Red Sea towards that huge potential market in 2026.
The clock is definitely ticking.
It's very, very intense.
And that brings us to our final provocative thought for you to chew on. The whole strategy of exiting Medicaid hinges on this idea of compliance. For a chronic, long-term treatment like Xiaxin, how much value do you think is really created by moving a patient from a 30-day script to a 90-day script? Can better adherence truly generate enough value to overcome the revenue loss from leaving those big government channels? Something for you to consider.